In today's video, I'll be making a full stock analysis on one of the largest and one of the best convenience store, which is couche-tard with the ticker ATD. As always, after checking out their business model, I'll be making a quick fundamental analysis followed by a price prediction of this business to see if it is currently under or overvalued. So without further ado, let's get to it right now. Originally created in 1980 by its founder, Alain Bouchard, couche-tard was a small convenience store located in Laval, Quebec in Canada. And the next 2 decades, this company hasn't stopped to grow both organically but also through different acquisitions that have made them the #1 convenience stores in Canada. And they now represent the world's second largest convenience brand in terms of the numbers of locations, with over 14,000 locations all around the world. In fact, after its entry into the US market in 2001, its expansion into the European market in 2012, and its coming into the Asian market in 2020, well, this company has started to acquire a lot of different subsidiaries. Indeed, over the last couple of decades, they've made a bunch of different acquisitions that help them to expand the scope of the operations. For example, they have acquired Circle K, Indigo, On The Go, and Holiday Station stores. And to diversify their business model, in 2020, they've even tried to acquire the European giant Carrefour for about $24 billion. But unfortunately, the French government has blocked this transaction. And more recently, couche-tard has agreed to buy over 2,200 gas stations in Europe from Total Energy. And the total cost of this transaction was about $3.3 billion. And it is another great way to expand the scope of the operations, but into the European market. All of this makes that this company currently worth over $50 billion and has generated some revenue of over $70 billion in 2022, which obviously mainly comes from the gasoline sales for the different cars. But at the same time, they are making a big part of their total earnings into the sale of different products in their stores. For example, from the sale of food, alcohol, or cigarettes. And more recently, they've also made the acquisitions of many great electric vehicles chargers, which will help them a lot in the future to build a strong position into the future EV market. In fact, it is expected that in 2024, they will have over 200 locations only in North America with some electric vehicle chargers. But the biggest part of those chargers are actually located in Europe at the moment, notably with their recent lab that they've created in Norway, which is mainly focused to find great solutions to the EV trend that will be coming all around the world. In fact, this facility created in 2020 is currently their largest site with over 40 total chargers. Add to this, in 2019, couche-tard has started in Norway to offer the services to charge people at their home or at their work. And in my opinion, it is one of the biggest reasons why couche-tard might be interesting, especially for people that have a long-term horizon, because most convenience stores at the moment have the struggle to find great alternative to the classical economy based on the gasoline cars. But keep in mind that in Norway, electric vehicles represent by themselves 90% of the total cars that are sold today. And so this represents a massive opportunity for this kind of company. But it is also why over the last couple of years, couche-tard has become a leader into the renewable infrastructure into the Baltics and into the Scandinavia, notably in countries such as Finland, Norway, and Sweden. Plus, over the last year, you can see that this company has gained over 20% of its total value, which was pretty surprising, especially with the drop of the oil price. But it is a pretty good news for the investors that is showing that this business isn't only depending on the oil price and on the total gasoline sales. Plus, the great management of this company has also been able to give and to provide some excellent returns to the investors over the last couple of years. But now, let's see what the financial metrics are telling us about this business. As you can see, couche-tard currently worth about $64 billion with a quite low price to earnings ratio of only about 17, which is showing that this company on that side would currently be undervalued. And in terms of profitability over the last 12 months, you can see that their profit and their operating margin are quite fair. But what is incredible about this business is their insanely high return on equity, which represent the total net income of a business divided by the total shareholders' equity. And in their case, it is about 20 23% of return. And over the last year, you can see that this business has been able to generate some revenue of about $72 billion, with an increase of 8% in their latest quarterly revenue growth compared to the same quarter but in 2022, and a slight decrease of about 1% in their quarterly earnings growth. Unfortunately, this company doesn't have that much cash, only about $1 billion compared to about $9 billion of debt, which means that it will obviously get impacted by the hike of their interest rates. Now, in terms of the risk represented by the beta on a 5-year period, you can see that this business doesn't have a lot of risk that comes with it, with a beta of less than 1, which is showing obviously that it will fluctuate less than the overall market, but over the last 52 weeks, you can see that it has still gained about 22% compared to some gains of close to 17% for the overall market. And as a shareholders, in terms of the dividend that you will receive, you can expect to receive slightly less than 1% of annual dividend every single year from this company, with however a super low payout ratio of only about 12%, which is showing that this business isn't using too much of their total net earnings to pay the dividends to their different shareholders, and instead they'll be using more their earnings to try to grow and expand their total operations and also to make some acquisitions as we've seen recently. And in terms of the total revenue of this company, despite a small drop in their total revenue in 2021 due to the drop of the oil price that was linked obviously to the pandemic, you can see that over the last 4 years, it has still been able to continue to grow pretty well. And this obviously has resulted in an increase and a great progression in their total net income. Now, in terms of the cash flow from operating activities of this business, which are the cash flow generated from the sale of their different products, well, you can see that they stayed pretty stable over the last 4 years, which has been pretty much reflected in their total free cash flow progression over that same period. And finally, to determine if the stock is currently under or overvalued, I'll be using as usually many different valuation methods that will help me to see what is the true value of it. And I'll be starting with the Pillar Lynch valuation method, which is a simple formula when you add the future growth of the earnings per share with the dividend yield and that you come divide with the total price to earning ratio. And with these hypotheses, you can see that the results would be showing that this stock would be pretty much overvalued at the moment. But unfortunately, this result isn't the best necessarily representation of the value of this business since it isn't offering any high dividend at the moment. Unfortunately, you can see that the dividend discounted model won't be working since the average growth rate of this business is higher than the weighted average cost of capital. And to conclude, as always, I'll be using the discounted cash flow model, which is in my opinion one of the best models to use, where you will come discount with the weighted average cost of capital the total free cash flow of this business, which represent the true value of it. And so as always, I'll start by calculating what is the cost of debt, and after I'll find the cost of equity to finish with the cost of debt and equity, which is giving us our weighted average cost of capital. And with these hypotheses, you can see that with the free cash flow in 2022, you can see that the true intrinsic value of this business is about $60 at the moment, meaning that with this valuation method as well, you can see that this business would technically be considered as overvalued with an upside of about less 8%. As you've been able to see in this video, despite being close to its all-time high, the advantage that couche-tard is providing to their different shareholders is that it is inflation and recession resilient. In fact, even if big businesses close and people have less money during inflation and recession times, well, they will still have massive needs for transportation and gasoline. And so it makes that this kind of company can only go to the stars, in my opinion, from this point, especially with some great business model and some great management, notably with all the challenges that are coming into the next couple of decades into the electric vehicle market. I personally believe that couche-tard has still a lot of room to grow, especially over here in Canada since the legalization of cannabis. Well, depending on all the legislations and the rule, maybe couche-tard will be able to sell these kind of products as the same title as alcohol and cigarettes. And despite not being considered as undervalued by most valuation methods, this company has still had some massive and some great financial results lately. And so personally, I still believe that it's not too late to buy this kind of stock. But on your side, if you want to find other great Canadian dividend stocks that you can buy right now in 2023 and hold for life, well, check out the video that's gonna be right over here, and I will see you soon. Peace!